Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth, and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining us this Friday afternoon, we have Sara Mehle. She is the ESG index strategist with Nasdaq Global Indexes. We're going to take a look at Nasdaq-100 performance. It's weak at the beginning of the year, but historically, what could that potentially mean as we round it out? Sara, it's great to see you as always. Welcome back to Trade Talks.
Hey, Jill, thank you for having me. Like, as you said, the Nasdaq-100 index has been a stellar performer over the years, but this year we've really seen some weakness. We're down a little under 13.5%. That'll be, some of those gains will be offset with today's performance. We did see a strong last 7 days, but just looking at this from an objective point and figure review, we can look at the point and figure chart of the Nasdaq-100 index. And what is significant about this particular chart, we're looking at the long-term 150-point chart, is that the chart we saw the trend line actually test recently a few times. And then this week on Monday, we saw the chart move to a triple bottom sell signal, which marks the second consecutive sell signal on that chart, and broke that trend line dating back to 2012. So we just saw that trend line, the bullish support line, celebrate its 10th birthday, if you will, but we did see that trend line violate this Monday. But we do have some good news here. We did see the chart return to a buy signal this week. We even saw it add an additional X with today's action, and so we're not too far off from a potential trend flipping that trend back to positive. And typically we do see those trend lines, stay negative and or positive for quite some time, but it doesn't come as any surprise that when we see elevated volatility that, we might see those trends flip back and forth.
And Sara, if we take a look at your second chart here, it's a little bit longer term, going all the way back to 1987. And we know what was significant with that year.
Yeah, so the second chart, we wanted to see where this year, so 2022, ranked when we look back at returns, the start of the year. We're going to call the start of the year from December 31st of the previous year through March 17th. So for this year through yesterday's close, we went back and we looked at every single year since 1987, and we went ahead and ranked them based on performance. And not really surprisingly, this is the fourth worst year on record, going back to 1987. Some other years that we saw perform a little worse, not surprisingly, 2001, 2008, and actually March 2020, kind of pre-COVID. We're just a few days away from the anniversary of that market bottom on March 23rd, but we're ranked fourth there. So what we did then is, we wanted to see, well, what does the rest of the year look like? What does that look like on average? And again, you have to look through each of these market environments through a different lens and with context, right? Historical context. So we did just that. We ran returns from March 17th of each year through the end of the year. So this year would be, December 31st of 2022, which we don't have that data yet. So on the screen, you'll see 16 years, but actually we're looking back at 15. So looking at the average performance, though, of the rest of the year, it actually has been pretty positive. So 73% of the time, we've actually seen positive returns, after a weaker start to the year. And we've seen that average return a little over 12%. So I think that this is an important data point to look at, meaning, just because we start off really weak doesn't necessarily mean we're going to end weak. I think the other, years that started, pretty weak, those are, around the tech bubble, great financial crisis, the, COVID bottom. We're in a much different market environment than that. And again, I really think that these should be looked at, again, for that historical context. But we also went one step further, and we actually wanted to see, so that sell in May and go away adage, that old market adage that we've seen, weaker performance through April 30th each year through October 31st. We wanted to see also, so if we see a weaker
Sara,
start
excuse me,
year,
this is your last chart here that you're referencing.
Yes.
Yes. Perfect. Okay.
Yes. So, yep. So that second column, or a fourth column there, excuse me, the seasonally weak period, we wanted to see, okay, if we start the year off weak, are we going to see continued weakness, specifically through the seasonally weak period, which again, sell in May, go away. And even those returns on average, turned out pretty positive. 70 or 67% of the time, we did see positive returns during that period. So again, through looking at these, which with each like a very different lens, I think the takeaway here is, again, just because we start off positive doesn't mean we're going to end positive. So we have, a lot of time to figure out what that's going to look like this year. But again, just some historical perspective to, just know that bad doesn't always mean it's going to get worse.
All right, Sara, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.